You think all this can last? There's a storm coming, Mr. Wayne. You and your friends better batten down the hatches, because when it hits, you're all gonna wonder how you ever thought you could live so large and leave so little for the rest of us.
Well, hello, Janusians. We're on to video 3. We're going to build on what we were talking about with respect to the US dollar in video 2. And this video, which is about the Federal Reserve's inflation dilemma. Just as a reminder from video 2, we were talking about how all of the geopolitical and global macro issues right now in the world are in one way or another connected to the US dollar. We had this famous quote from John Connolly, who was Secretary of Treasury in 1971, who said, "The dollar is our currency, but it's your problem." And that certainly holds true today. And we talked about in detail in the last video the role of the US dollar in trade and financing. If you recall from your intermediate or introductory macro courses that the role of the central bank, any central bank, is generally to trade off two dual mandates. On the one side, they're supposed to have stable prices, so they're supposed to maintain inflation rates that are low, and generally speaking, they like to keep inflation below, 2%, because if inflation gets too high, the central banks are worried about that expectations of inflation in the economy will become self-perpetuating and that they'll become de-anchored. So there's an inflation mandate that every central bank has, and there's also a mandate around promoting economic growth and lowering unemployment. Now, of course, these two things, when inflation is running, these two things can be at loggerheads. So generally speaking, the central bank will make a commitment to stabilize inflation and inflationary expectations at the expense of unemployment, and then worry about unemployment later on. Now, as mentioned, if we want to talk about the U.S. Federal Reserve, the central bank for the United States, they would have an additional role, or rather, I might say, their role in terms of maintaining stable inflation in the United States is goes beyond the responsibility of a traditional central bank, because the U.S. is the reserve currency. And so since lots of countries and businesses around the world are using U.S. dollar assets as savings vehicles, that means that that there's an added expectation that the priority of the U.S. Federal Reserve should be to stabilize inflation rates in the United States, not only for itself, but for the sake of the rest of the world. Because, and more specifically, in terms of risk-free assets, the U.S. Treasury bond is the savings account for the world. So most of sovereigns and companies that want a risk-free liquid asset, they invest in U.S. T-bills. So, but this is only going to work, of course, if the U.S. has stable inflation. The Federal Reserve chairman in Paul Volcker in the 1980s, he went as far as raising short-term rates to 19% and essentially put the U.S. into a very, very deep recession, a deep sort of what they call V-shaped recession that was deep but short and crushed inflationary expectations. And the current president of the Federal Reserve has modeled himself or spoke of Volcker as being a hero, and him seeing that perhaps right now is his Volcker moment. We're going to suggest a little bit later on in this presentation that the Federal Reserve's ability to purely crush out inflation is going to be somewhat limited in this particular cycle, and we're going to suggest why that is, and why you can't see the U.S. Federal Reserve raise rates to 19% or anything close to that in this period because it will be too destructive. If we look at the history of oil prices, we can see that oil prices have remained relatively stable from the 1980s to the aughts, where oil sort of traded $10 and $30. Maintaining an oil price that was stable was sort of key, because oil, again, is the basic unit of energy and it really is the foundation. Cheap oil prices are the foundation for our modern economy, because everything that we build and that we consume has an energy component, and oil is one of those primary energy sources. After the 2000s, chairman of the Federal Reserve at the time, Alan Greenspan, he broke away from this tradition of maintaining oil prices within that $10 to $30 range that I spoke of. Critics of the Federal Reserve would say that they've been, since the Greenspan era, have been in the business of blowing one type of bubble or another. We had a .com or a tech bubble in the early aughts, which saw the NASDAQ, or the stock exchange that represents technology stocks, contract 75%. That was at the beginning of the aughts, on the wake of an emerging market crisis that started in 1999 that was called the Asian contagion. We had a housing bubble in the 2000s. Greenspan just let housing prices roll, and that led to the 2007 financial crisis, global financial crisis. I alluded to that crisis in the previous video when I talked about the collapse of Lehman Brothers in the UK, but that crisis was predicated on derivatives that were based on U.S. housing contracts, or what we call mortgage-backed securities or asset-backed securities. Now, it was quite the heyday. China was, of course, industrializing, and there was a tremendous migration in the aughts in China, and their demand for energy was basically insatiable, as they were having all the peasants move out of the countryside and into the industrial areas, and a barrel of oil was extremely productive from a Chinese perspective. And then the U.S. housing market became very speculative. And I remember in 2005, I went to Las Vegas and I was playing cards, and the Las Vegas housing market had gone up 100% in the previous years, or previous year rather. And I remember sitting at the table talking with a real estate agent who said, "Oh yeah, well there's another 25% to go." And he turned out actually to be right. It might have sounded incredulous, because normally housing in the United States up to that point had been growing at about the rate of nominal GDP, so around 4% a year. And housing went up in a single year in Las Vegas 100%. Overall, then, when the housing crisis in the United States collapsed, housing prices fell by 40%. And the global financial system effectively collapsed and had to be bailed out. During the collapse of the U.S. housing market and the world financial system, during what became known as the Great Recession in popular parlance, the Federal Reserve began a program called quantitative easing. And this was a program where it purchased at book value, the value of the mortgages from the banks, so that they could restore the capital base in the United States. And it also purchased aggressively U.S. Treasury bills to keep rates really low, long-term rates really low in the United States. That program, which expanded the U.S. Federal Reserve's balance sheet from 800 billion to 4 trillion was called quantitative easing. U.S. moved away from managing the U.S. dollar on an inflation basis, or being worried about the amount of U.S. dollars on an inflation basis, because they were focused very much on restoring the domestic health of their financial system and their economy in general. And this wasn't particularly problematic at the time because, of course, we were in a period of extreme goods devaluation, principally because China was becoming the manufacturing base for the world. And around that time, as we turned the corner on the decade and moved away from the aughts and into last decade, there was the emergence of shale oil in the United States that was starting to become a driving force in the global economy. So the U.S. had technologically invented a technique that allowed them to extract light oil from rock formations and gas. In fact, the technique was developed first in natural gas. And this caused first natural gas prices to collapse at the end of the aughts, which went from $10 a TCF to $2 a TCF. And then the collapse, shale oil really came on the scene in about 2014, and we saw oil collapse from over $100 a barrel to $45 a barrel, and then would spend most of the rest of the next 8 years until really this year stuck under $60 to $70, so somewhere in the $40 to $60 range most of that period of time, as production in shale oil ramped up. So we can see on this graph here that if we're looking at price changes over from 2000 to 2021, most of the escalation in costs in the United States went into education and healthcare, and basically in services. But if we looked at the goods market, we saw a tremendous amount of deflation, and this is because the U.S. was in the process of offshoring the production of its goods in principally to China, but to other places of the world. So let's remind ourselves of, in macroeconomics, what we mean when we say two terms. So deficit is a flow concept in economics. It's the amount that the difference between what the government takes in tax revenue versus what the government spends. Often is expressed as a percentage of GDP of an economy for comparative purposes across countries. The stock variable is the federal debt. So in Canada, we have now a federal debt that's around 130%, and the U.S. federal debt is slightly over 120%, was 128% at its recent peak. If we look at the kind of budget deficits the United States was running, and this is for much of the last decade, they were running a deficit in 2012 that was about 6.7% of GDP, 4% in 2013, 2% in 2014, and on. And we get to 2019 that it was negative 4.5%. But then in the last 2 years, during the COVID crisis, the U.S. in 2020 ran a 15% deficit, so up 10%, and then from 19, and then a 17% deficit in 2021. So 2020, that was a Trump budget. 2021 was a Biden budget. And there was an additional $4 trillion worth of spending that was designed to support the U.S. economy fiscally as a fiscal stimulus because the interest rates were already extremely low, because the U.S. had been keeping those interest rates low since the global financial crisis. And as a result, there was no real ability for monetary stimulus in the United States. So the government took it on itself to provide demand stimulus in the form of fiscal stimulus. This in and of itself wouldn't have been necessarily a problem, but of course it blew up the federal debt to its high point at 128%. And now it still sits at over 120% in the United States. Well, they had handouts to businesses and consumers, and this essentially forced the U.S. federal government to issue debt to fund, because of this deficit. They had to issue $4 trillion in extra debt. That $4 trillion was purchased effectively by the U.S. Federal Reserve. And the money, of course, went to consumers and to businesses and wage subsidies and different kind of relief programs that they had, some of which were better than others. And as a result, this is what we call a balance sheet expansion of the Federal Reserve. So we see that U.S. money supply, M2, increased from, in 2020, 16 trillion to 22 trillion, and the Federal Reserve was obliged to expand its balance sheet from 4 trillion to around 9 trillion. So this 40% increase in the U.S. money supply wouldn't have necessarily been as inflationary as it has turned out to be were it not for the fact that we have supply shocks. And what we're seeing is there are tensions between China and the United States. There's issues around intellectual property. The U.S. has told NVIDIA not to sell its advanced AI chips to China, and that NVIDIA plant is in Taiwan, and there's concerns about a potential invasion of China into Taiwan. Of course, we've got the Russo-Ukrainian conflict, and that in and of itself has caused Russia to weaponize natural gas in particular against Europe. One of the things that happened in the wake of the shale revolution, and we'll get into this, where there was a big increase in U.S. production of oil. We'll get into this more in a subsequent video, but there's been a real disinvestment in oil for various reasons. Part of it was investor inexperience with the shale production model. Part of it was we've had a ESG and green movement that has effectively looked at curtailing investment in oil. And part of it, of course, was COVID, that businesses kind of sat on their hands when COVID happened. And so complicating things in terms of the U.S. market, where the U.S. also saw a major decline in its labor force. Somewhere around 2% of the labor force was lost due to long-term COVID issues and early retirement. I myself have had long-term COVID issues. I got COVID in January, and I'm still recovering from that myself right now. There's a graph here that was based on research that was done at the San Francisco Federal Reserve. The Federal Reserve believes that inflation is about 4% over their range of where they would like to see it, which is at 2%. And when they decompose what part of that inflation is from demand, they come up with about a third of it comes from demand. That's the right-hand side, or panel B, the contribution to inflation. And the left-hand side is the supply-driven side, which is about 2/3 of the reason that inflation is over target right now. PCE is the personal consumption expenditure index. That's the Federal Reserve's primary consumer index that they use to measure inflation. Normally, if you were a classical economist, you'd say, well, so supply will adjust rather quickly and we'll get back to our long run expectation of growth, and therefore we should imagine that this contribution to inflation of 2/3 of inflation would just go away in due course. This would be transitory, as we say. The problem with that argument is that we have, with the Russian-Ukrainian conflict, we have a constraint. We've had about a disinvestment in the energy complex that starts to get to over $2 trillion worth of disinvestment over 8 years. So we've got a fair amount of catching up to do if we're going to reestablish oil inventories, because there's really no oil inventories in the world to speak of anymore. And now the Federal Reserve is in a terrible quandary, because if it wants to really crush inflation down to its 2% range, it's going to have to push back against supply inflation, and it's going to have to be extremely destructive to economic growth to get that supply side of inflation to come down. You're basically going to have to destroy a lot of economic growth. And that means that you're going to have to keep raising interest rates. And that further complicates, of course, the Federal Reserve's problems, because as they raise their short-term interest rates, they also raise their US dollar. And as we spoke about, this puts all kinds of pressure on foreign businesses and foreign governments that have used, that are energy importers in this time of constrained energy and wheat, food commodities that they need, and they need US dollars to buy them. So that creates an inflationary spike for them. And it further complicated, we might say, well, let's just take our medicine like Paul Volcker, the Federal Reserve chairman in the 1980s, gave it to us. Why don't we just take it as a big washout, deep V recession and have it be over in a year and a half, and we can get over this thing. But there's a problem right now, and the problem is that when Paul Volcker raised rates to 19%, the U.S. had a federal debt that was about 60% of GDP. And now with U.S. federal debt probably going to approach 130% of GDP this year with the deficit that they're going to run, and the further fact that much of the U.S.'s debt is serviced in short-term U.S. Treasury bills, so that they have to refinance about 1/3 of its debt every year. This means that if you raise short-term rates, you're going to raise the cost of borrowing for the U.S. federal government, and you could quickly get to a point where you can imagine that if you raise rates to 5%, say, and the U.S. economy is collapsing, or even just let's imagine 0% growth, at that same time you're starting a debt spiral, because now the deficit might be 8-9%, and you're adding and your economy is not growing above the rate of the interest rate that you're borrowing at. So that's what's called a death spiral loop. So the Federal Reserve is in a very, very difficult situation right now, where there's sort of a rock and a hard place, damned if you do, damned if you don't. You could use whatever cliche you want, but they really have a struggle. Now they've committed that they're going to, they're going to keep going, and they're going to wait for the economy to slow down and for unemployment. And the fact is, unemployment is a lagging indicator, so that means that they're willing to really break the economy. But the problem is, of course, that they're in the process of destabilizing the yen, the British pound, and the euro, and creating a sovereign debt crisis or at least significantly contributing to a sovereign debt crisis, which would probably lead to a global financial crisis. And of course, I think we can say there's an emerging market crisis is baked in the cake, because there's 20 countries right now that are on the emerging market countries that are on the verge of defaulting on their debt. So the Fed, this is what in the popular media they talk about the Fed pivot, that there's going to have to be a Fed pivot because they're likely going to wreck more than just the economic growth of the United States or even the West for a year or two. They're probably going to destroy the global financial system and the credit markets, and then they're going to have to back off of their stance. And what that's going to mean is that inflation is going to have to run. And then when inflation runs, that means that the U.S. Will no longer be a good serviceable currency for the world's reserve currency. Now, it should be noted that Fed, and again, we talked about this in the last video, that the Federal Reserve is actually already engaged in an unprecedented level of the rapidity of tightening over a period of time and the amount that they've tightened. So they've gone from 0 to 3% in basically 9 months. And this is unheard of. This has never been done. And of course, this is putting a tremendous amount of stresses on the global economy. The Federal Reserve policy of raising rates dramatically, magnitude and rapidity, is actually in a way working counter to prolong working counter to its desires. It's working to prolong the supply response. And it is doing that for the following reasons. So when you increase the interest rates in the economy, you increase what we call the cost of capital, the cost of borrowing by consumers and business, and that cost of borrowing by businesses basically deters investment. If the global economy is being threatened, and we're in the middle of a war, and let's face it, NATO is fighting a proxy war with Russia right now. It's not just the Ukraine, but it's effectively a NATO proxy war. This creates a tremendous amount of uncertainty in the global economy, and there are not a lot of business leaders that are going to make long-term investment commitments right now when they haven't seen how this whole NATO proxy war with Russia has turned out. The one thing that you can't do when you're a central bank is you cannot, in the expansion of your money, you cannot create more stuff. You can't create more oil. If you're in favor of expansion for the green economy or electric vehicles or renewables, well, you can't also make more copper or the precious metals that are needed to supply the green economy. And of course, the Federal Reserve itself cannot do anything to resolve the geopolitical tension that's going on. But right now, they, in order to maintain its credibility, they have been raising rates. And I'm of the opinion, of course, that they've raised too fast and too far. There's a saying that when you only have a hammer, everything is a nail. So the Fed only has one response to inflation, and that's to raise interest rates and to work at contracting the money supply, and that goes beyond the issue that can be self-injurious, as I've pointed out. So how would we get out of this quandary? Well, we'll have more to elaborate on this in future videos, but we of course, would want to look at the long-run expansion of supply. So you want to look at expanding labor. You want to look at expanding energy. You want to look at expanding metals for the green economy. So you want policies that are going to be long-run supply expansionary that you need. In an ideal world, you would find a way to reestablish workable, tradable diplomatic relations with Russia. Whether or not that's possible or going to be doable, I guess we'll see going forward. Right now, it very much looks like the U.S. Dollar system isn't sustainable. We've got too much debt in the world, and we are likely to see the major economies of the world, the United States, the Japanese, the UK, and Europe, end up effectively having sovereign defaults on their debt, where they will effectively run high inflation periods. This is what will be called yield curve control, and where at some point they just start buying all the debt that their governments are issuing, and they just let inflation run until the real value of debt is down by about 50%. I personally wouldn't be surprised if in the next 3 years we didn't see an inflation print in each year that is 25, 25, 25. That sounds, I'm sure, shocking to many of you who are hearing that. Goldman Sachs has already predicted that the UK inflation rate could easily hit 25% next year. So I'm not even, with respect to the UK, saying anything special. I think going forward, one of the things that's going to happen is there's going to be a movement, not an immediate movement, and certainly not on an exchange rate basis to completely replace the US dollar as the reserve currency, but a movement away, or a general trend of movement away. And we're seeing some of that already happening between China and India and Russia, that there's already been agreements where they're going to transact in their currencies. When John Maynard Keynes ran Bretton Woods, instead of the US gold system, he had suggested a system that he called Bancor, which would be where countries bilaterally settled their trade agreements, and any excess trade between the two would have been settled by buying gold. And I expect some type of system like that, where trade will be settled on a bilateral basis, and maybe gold and maybe even Bitcoin will be used as this Bancor asset going forward in this high inflation environment, which I expect us to be going through in the next 4 or 5 years. This is the only way that energy importing countries can regain their economic sovereignty. So they're going to have to move away from the US dollar if you are a country that imports your energy. And the energy producers, of course, like Saudi Arabia and Russia, they don't want to hold U.S. treasuries when they believe that the U.S. is getting set to devalue its currency over a long time. And in fact, there's a speech by Vladimir Putin where he talks about the fact that he doesn't want to sell his oil and then get in an asset called U.S. dollars in return that's depreciating at 8% a year. And that's what he's talking about, the expected depreciation of the U.S. dollar. Well, Venusians, I'm just a ray of sunshine and light in your life. Look forward to seeing you again in the next video. Hope all is well. Take care.
The man is flawed from day one, and that there are no solutions. There are only trade-offs. And whatever you do to deal with one of man's flaws, it creates another problem, but that you try to get the best trade-off you can get, and that's all you can hope for.